Hello and welcome to the first video on Chapter 14, Financial Statement Analysis. So we're breaking away from what we've been doing in the past. In the first part of this semester, we were talking about how companies use costing systems and different costing methods in order to get numbers that will eventually go to the financial statements. So what we're going to talk about in this chapter is how managers actually use financial statements to make decisions. So if you think back to our last course, Accounting 221, Introduction to Financial Accounting, excuse me, what we were doing there was we were preparing the financial statements. And what there was the income statement, the balance sheet, the statement of retained earnings, and a statement of cash flows. What we're going to be concerned about here is those two of those financial statements, the income statement and the balance sheet. But the truth of the matter is those statements, when you just look at the numbers, there is really no significance in just looking at the numbers. There has to be a way to analyze them to get the information valuable for managers to make decisions. So that's what we're going to look at. And there's three major ways they do that. And that is through comparative statements, through common size statements, and then through ratio analysis. But before we start talking about them, let's talk about a little bit about the limitations of what we can do with financial statements. If you remember back to Accounting 221, there were some limitations. So what were some limitations of the balance sheet? Just think for a second. Well, one that pops right into my head is the use of estimates, right? There is a lot of estimates on balance sheets when it comes to what they expect not to collect from accounts receivable, the allowance for doubtful accounts. There is the estimate of depreciation expense on the property, plant, and equipment instead of it being at its fair value and stuff like that. It is also just a snapshot in time. So as soon as we're doing ratios and we're comparing stuff that's sitting on the balance sheet, well, 2 months down the road, all that could change. So those ratios could actually be meaningless. Okay. But it is the best we have to go by, and it is what investors use and what managers use to make their decisions. Okay, so keeping those one other limitation I want to bring up, I almost forgot about, it'll show you in the slides, is different accounting methods. And this is a major one, especially when you start comparing between two different companies. If one company is using a FIFO inventory method and one is using a LIFO. If you remember back when we were doing that, if we're using a FIFO, the first in, first out, because of the price of goods will usually increase over time, we're using our first ones, we're going to have a lower cost of goods sold and a higher net income. If we're using LIFO, last in, first out, we're typically going to have a higher cost of goods sold, which is going to produce a lower net income. So if you're trying to compare ratios or numbers between two companies and they're using different accounting methods in that regards, it's going to make their numbers, it's like comparing apples to oranges. So stuff you need to pay attention to in your future if you're looking to which companies to invest in. Well, make sure that you're looking at all the little minor details, what goes into making those numbers, because as you saw just a little bit in your intro to financial accounting, there's a lot of adjustments and a lot of assumptions and a lot of different methods to get the same number. So it's important to understand how those numbers came about. Okay, so what we're going to do now is we are going to look at the comparative statements and the common statements and some trend analysis. What I should have mentioned before, and I will put this in the email, is that I have a handout that is in an Excel format that is in the Unit 3 folder that is on Moodle. So I would like you to take a minute, pause the video if you haven't seen the email or you didn't open it before the email, and go in and open that up and either print it out or open up and maybe do a split screen. You can put me really small in the corner where you can see the income statements up there, okay? And then we will go through them after you get that ready. Okay, so I hope you have the statement with you now. They are called for Cover Corporation, and it has 4 tabs across the bottom. It has a comparative tab, a trend analysis tab, common statement tab, and a ratio analysis. We're going to worry about the first three today. Okay, so comparative statements, what we're going to do is we're going to look at one company and we're going to compare at least 2 years, but it's usually multiple years. But in our example here, we only have 2 years. And what we want to do is we want to look at the change in the dollar amounts and the percent that is changed from year to year. Okay, that way we can get an idea of how the company is progressing or regressing in each of their different stages. Okay, the whole purpose of this though is to lead to the second point, which is trend analysis. When you get multiple years put out there, you can kind of see trends start to develop and maybe how management can make decisions to kind of reverse trends that are negatively affecting the company. But on the first page of your comparative statements, we have corporations comparative income statements for the years ending December 31st. So what we want to do is we just want to find how much has changed from year to year. So I'll move back here so we can go up to the whiteboard. And let me grab my eraser. Corporations, you can see their sales. 520,000 for the first year, or for this year, okay? Last year, they were at 480,000. So that was this year, last year. The next line over is the amount of change. So we just want to take how much was from this year, how much did it change from last year? For a change, this minus that, 40,000. Okay. So if you're doing this in Excel, if you have your sheet pulled up, what you want to put into that column, you can just hit enters, the equal sign, enter equal sign, and then click on B2, cell B2, and then minus, oh, excuse me, that would be B5 minus C5. Okay, and that'll put that number in there for you. The first thing you want to do is you want to find the change all the way down the board for every one of those. Okay, so if you're not familiar with Excel, after you have entered that, and maybe you clicked off of it, you click back into that cell, and come up and have this little box down here. Click on that little box and just drag down all the way down. It'll copy that same formula all the way down to the end of that sheet. Okay, and then it'll give you all of your differences. The next sheet over, the next line over is our percent mark. Okay, in order to find our percent, we're going to take the amount that was changed. We're going to divide it by our base year. Okay, our base year is always going to be the last year, or if we have a list of years, or many happened, say from 2004 to 2010, our base year was always going to be the first year that is listed there. Okay, so we want to find the percent change here. So this one, we would take 40,000 divided by 480,000. Okay. Put that in a percent format, and that comes out to 8.33%. You can tell the sales from 520 to 40,000, we rose sales 8.33%. Okay, so the calculations on that are pretty easy. If you're doing that in Excel, again, you can put equals. Now you have the change amount, which is cell B5, and then divided by, we want to remember to use our base year, which is in C5. So this one will get you your change. This one will get you your percent. So I would like you to take a minute now and once again, pause the video, and for the comparative income statements, go through and find the change for each of the categories and then go through and compute the percent change. After you get those done, unpause the video and come back. I'll show the numbers to you and then we'll talk about what they mean. Okay, now that you've got your answers, I computed it on my Excel sheet and I'll hold it up here. Here are the percents for the comparative income statement. Okay. So what can we learn when we pull something like this and we start looking at it for just 1 year? Well, as we can see, the sales went up by 8.33%, but the cost of goods sold increased by 14%. Okay, so why? Maybe the cost of supplies went up, or the cost of labor, and some of that manufacturing overhead, but something changed in our cost of goods sold that drove it up 6% higher than our sales increase. Okay, so that could signify a problem. Maybe we are pricing too low, maybe we didn't hit our sales. Who knows, but that shows that there's a little bit something because your cost of goods sold should stay at about the same percent of sales. It should not fluctuate that much, okay? And that is definitely something management has control over. So that in turn causes the gross margin to drop by 3% from last year, even though we had an increase in sales. The operating expenses increased minor. That's something you can probably expect because of inflation, about a 2% increase. Okay, so that seems pretty normal. But all that makes the net operating income drop big time by about 20%. Okay? And then everything else kind of below it kind of stays the same. So from this, the one thing I would want to investigate if I was the manager is why did my cost of goods sold go up? Okay, we don't get a straight answer, but it gives us something to look at. Okay? So it's a starting point. That's what you can do with comparative income statements. Now you can imagine if you put these out year after year after year, where we put maybe last year, previous year, 2 years before, we can look at this and see maybe something just happened that year with cost of goods sold, where maybe like this year there was a natural disaster, okay, or a virus disaster, COVID, and maybe they had trouble getting supplies. So the price of their supplies went up, which made their cost of goods sold go up, but it was a 1 period thing. And after the emergency was over, everything returned to normal next year. So there's something you might need to look further into, but what comparative income statements in this manner do will give you a starting point on to look at something that just doesn't seem right or reasons why something is happening. All right. So if you would move on over to, or pull out the next page, the trend analysis, you can kind of see what I mean here. We got the same corporation, but instead it's listing out sales, the cost of goods sold, and the gross margin for 3 years. Okay. So when we're doing trend analysis, remember we are always going to start with year one or the earliest year. So moving back to my board here. We get to the trend analysis. You don't even have to think about it. My first three are always going to be 100%. Okay? Because year one is my base year. That is what I am basing everything on. Okay? So since what I'm doing here, if you look at your numbers before, I have sales. So I'm going to take sales. I have year one divided by year one. That is how I get 100%. My next one is cost. Same thing. I have year one divided by year one. And down at the bottom, our gross margin. So as I said earlier this year, your base year is always 100%. Now we're going to look at trends. What happened to sales in year two? Well, our year two sales were 290,000 compared to the 275 we had before. So for year two, we were going to take year two divided by our base year, year one. We do that. 1.05, turn it into a percent. So for year two, our sales are 105%. And if you were doing this on Excel, and you just want to put it in, it's a little bit different. Stand up here. So when you go into where B9, in B9, you need to put equals. You can click on B4 divided by. Then you have to click off B4 and right back onto B4. But before you hit enter, you need to hit F4 on your keyboard, okay? On mine, I have to hit the function key at the same time as F4 because it's up in the corner. But when you hit the F4, what you'll notice in the little entry bar is it'll put dollar signs in front of the B and in front of the 4. Okay? Why that is does that is because it locks that cell into place. Because we're always going to be dividing by the base year. So in B9, you know, B4 divided by B4, which I said here is year one divided by year one. Then as you drag that across, as you did drug down on the other one, you drag this one across, it'll keep B4 at the bottom. So it's, you know, year two divided by year three. And when we get to year three, it'll be year three divided by year one, year four divided by year one, and year five divided by year one. Okay, I hope that makes sense. So we go across the bottom of that page. Okay, for our cost of goods sold. Again, 100% year one. When we get to year two, we take year two, which was 198. And we divide it by the 190,000. We do that, we get cost of goods sold at 104%. And our gross margin is 92,000 divided by 85,000. Goes up to 108. So I always say, just take the year that you have, divide it by your base year, and that is what you put into your trend for each year. So pause the video again, take a minute, go through, find the percent trend change for each of the years and the sales, the cost of goods sold, and the gross margin in each of the categories. And when you unpause, I will show you what they are and we will discuss a little bit on what they mean. Okay, so hopefully you got all your trends now. Let me put this up here. That is what your percent should be for your trend analysis. So if I'm a manager and I have a trend analysis going, as in our first year, the sales improved by 5%, cost of goods sold only by 4%. That was a good thing, 108%. But what I've noticed is I keep looking through, the cost of goods sold seems to be continuously, after that first year, it's going up. It went up 118% and 132, then 150, but sales are only 116, 129, 145. So they were 2% behind, 3% behind, now 5% behind. So despite that good first year, it's really killing the profits because profits are increasing, they're going up. But in the first year, sales dropped by 5% and profits increased by 8%, which is a good thing. That's a great thing because it means they were controlling their cost of goods sold, because you can see it jump less than sales, which in turn, that multiplier is going to kick profit up higher. So even though when we look at year three, they're 12% higher in their gross margin, they're 16% up in sales. So if you're 16% up in sales, you would hope your gross margin would be higher than that, because if you're thinking about the variable and the fixed costs, right? As soon as you cover all the fixed costs, your contribution margin is all profit. So sales are increasing, they've already covered their fixed costs, their contribution margin per unit, if it would have remained the same, should have kicked that profit margin even higher, the gross margin. So if they could have controlled their cost of goods sold and kept it at the same or lower amount of what their sales were raising, you would have seen exponential growth in that gross margin. Okay, so that's the kind of information you can learn from a trend analysis when you're looking at companies' performance. All right, finally, in this video, we are going to look at common income statements. Okay, common income statements are on the third tab. And I apologize, I have them labeled on there as comparative income statements. They should be labeled as common income statements. I just saw this. The thing is even though they're labeled as common, they are we're going to use them to compare year after year. But the common statements are going to be shown as a percent, but it's only based on this year. So, okay, easiest way is to just kind of explain it as we work through it. We have an income statement and a balance sheet here. What we're going to do is we're going to take each category and express it each year in that year for the income statement of how much it is of sales. For the balance sheet, we're going to express everything on how much it is as a percent of total assets. Okay. This is a great tool to see why things have changed. Okay. So maybe because if cash was 20% of our total assets this year, but in the next year it's only 10% of our total assets, we want to see why. Why do we have a 10% change in the amount of cash that we have? Okay, kind of gives the same information you're going to get from a comparative income statement, but it just puts it in a different format because, like I said, numbers by themselves are kind of mean nothing. You got to use them to compare and contrast, and you got to use the industry that the company's in and maybe some industry standards. Okay, and you have to look things from multiple points of view in order to get a full picture of what is going on. So let's take a look at these common statements. As you see, we have the same income statement, but I have also added a balance sheet for this one. The balance sheet can be done under the comparative statements, but usually the information gathered from that is not as helpful as the income statement, because we really want to look at our cost of goods sold and our gross margin and our sales for those trend percentages, that trend analysis. So most commonly that's only done with an income statement, but when we do a common one, we want to do it for both the income statement and the balance sheet. So we have the exact same income statement that we had before. But as I said, when we do a common income statement, what we want to do is base everything off of a percentage of sales. So let me erase my board here. So on our sheet here, we have sales of this year, 520, and last year, 480. Okay, so when we're doing common statements, we are going to base common income statements. We are going to base everything off sales. So what we want to do when the next two columns on your sheet is going to be a percent answer, is going to be what percent of sales or cost of goods sold or gross margin. What percent of sales are they? So here you would have 520,000 divided by 520,000 equals 100%. Your sales are always going to be 100% because what we are basing everything off of. Okay, so and then the next one would be 480 divided by 480. We get the cost of goods sold. Okay, look down here, 360 and 315 are our numbers. What we're going to do is calculate what percent of our sales they are here. So for year one, 360,000 divided by 520. And when you do that, you find out that your cost of goods sold is 69.23% of sales in the first year. You would do the same thing for year two, 315 divided by 480. Okay. Gross margin was 160 and 165. So for year one, you just do the same thing, 160 divided by 520. We see that our gross margin was 34.38%. Simple enough, okay? Just always take whatever number you have and you divide it by its base years. Okay. So you can go ahead and do that on down the list for the income statement. But for the balance sheet, remember the income statement, we were basing everything off sales, which is our top line, which is pretty easy to remember. For our balance sheet, we are going to base everything off of total assets, okay, which is going to be the bottom line, or of the balance sheet. Okay, so if we look at our first line up here, we have cash, 30,000 and 20,000. So our percent for year one is going to be our 30,000. We're going to divide by the total assets. So you have to go down to the bottom of your sheet that's highlighted there in black. The total assets are 346,390 year two, the total assets were 300,000. Okay. So we'll go for year one. We take our 30,000 divided by 346, 390, and we get 8.66%. So again, it's simple. Just remember you're using total assets as the base. You'll go through and do that for all of your assets. You'd also go through and do that for all of your liabilities and equity. And remember the accounting equation that assets equal liabilities plus equity. So our total assets will equal our total equities and liabilities. So you can use that as your base number when you're on the bottom part of the balance sheet. So once again, I want you to take a few minutes, pause the video, go through and do the numbers for the comparative or the common income statement and the common balance sheet. And when you come back, I'll show you my numbers and we'll talk about what they mean. Okay. Now that you've got those done, here is a look at what the common income statement would look like. Slide it up a little bit. Show you what, oh, I moved my finger here. And show you what the balance sheet should look like. Here you have your asset section. And there you have your liabilities and your equity. Some numbers that jump out to me as I look at this. Again, on the top part, you can see that the gross margin has dropped by 4%, and it's the same amount that the cost of goods sold has went up. It's caused the it's probably the primary change on why, even though. So yeah, we're looking at year one compared to this year. Okay, so it gives us basically the same information that we got from the comparative statements. That's why our income was only 3.37% of sales this year, while it was 4.67% of sales. Okay, we like to see that number a little bit closer together. We want to figure out what the discrepancy is, and the 4% difference in the cost of goods sold caused about a 1% difference in the drop in our net income. Okay. From further investigation, we can look through stuff to find out what else has the company been doing besides operations. Okay. So I'm looking through our statements down in the balance sheet now, and one thing that I noticed is that the cash is 8.66 of our total assets this year. It's jumped about 2% of our total assets. Okay, doesn't seem like a lot, but it is really the only thing that's jumped in the current assets, and it kind of stood out to me. A 2% change is a pretty big change in the cash. But the biggest change is right below that. Our land jumped up 47.63%. Also makes me kind of interesting because our cash jumped up and our land jumped up. In my mind, if I was looking at it, I would think if we bought land, if we spent some money on an asset, probably our cash is going to go down if we're going to use some cash. So I'm going to want to look and find out what did the company do in order to get that land and in order to increase their cash flow so much when their income decreased. Okay, so we have a decrease in income from the previous year, which probably meant a decrease in cash flows, even though it was a little bit higher. You know, a little less percent. Money was a little bit tight, but we still got more cash and we bought some land. So we can look down at the bottom of the balance sheet that everything is pretty similar. The accounts payable dropped a little bit. The notes payable actually went down, so it shows that we're paying off the notes payable. So we did not take any long-term notes, so we didn't borrow any money for that. But the equity jumped up. The common stock and the additional paid-in capital, they both jumped up by a large amount. Okay, so what it tells me then is that the company issued some more stock. They got investors to come in, and they got that money in order to buy some land, and then they had some cash left over for their operations. Maybe they needed a little extra working capital. So that's some of the information you can kind of pull out from these. Um, the process of finding these numbers is very simple. The process of determining what the numbers mean sometimes can get very complicated, and it really requires a lot more research. But the whole point of this is give you a place to start, a place to look at as a manager or an investor, a place, so you can make an educated decision on the best action moving forward. Okay, so that's it for this video. Our next one, we will be talking about ratio analysis, which is the fourth tab on the Excel spreadsheet. So please have that printed out or have it pulled up like I had you do today, and have that ready to go. We will use some different numbers for that, and we will go through. And again, none of these are hard to find or hard to do. There is just a lot of information and a lot of computations to remember. But if I didn't mention this before, the good thing about this is you're not going to be tested on any of this. So chapter 14 will not be included in your test, because the bad news is it is part of the assessment project you have to do. I will be introducing that to you guys on Wednesday, but that is how we will evaluate this chapter for the course. You'll have to do a comparative analysis between two companies using the information presented here, and kind of decide which company you think is operating at its best. Okay, so hope you enjoyed this first video, and I will talk to you guys again soon with the ratios, and we will talk about them.